What's up, everybody? Welcome back to another episode here on the channel. And today I'm going to be talking about asymmetric returns, asymmetric upside, asymmetric downside. This is a question that I've gotten a couple times, and I think it's a really interesting topic. So I wanted to just simplify it down in a really boiled down version for everybody because it's something that I've found really kind of one of those hacks that a lot of billionaires and very wealthy people take into account when they're making investments, whether they're valuing a real estate investment or a stock that they're buying. So that sounds interesting. Slap the like button and definitely stick around till the end for a little bonus. So let's imagine you have $100 that you want to invest in, let's say, a stock, Tesla or something like that. You're investing in $100 into a stock. Now, when you're looking at the chart of the stock, you're looking at the value where they're taking a value every day. But if you're thinking about the intrinsic value, you're thinking that you really need to think into the future. You need to think about what the value is going to be in the future. What do I value it at today? What is it going to be valued at? Is it undervalued? So when you're thinking about the intrinsic value of a stock, for example, that you're going to be buying, when you have that $100 that you've worked so hard for, that you're getting ready to invest, you need to look at your downside and your upside. There's a great guy named John Chen who I had on my podcast, the Sound Money podcast, actually, in the past, and he came from a really big hedge fund on Wall Street, and he said that the saying at hedge funds is always look down before you look up, meaning always look at your downside, your potential downside to any investment before you even get involved in it, before you even start researching and digging deeper and deeper and deeper. Always look at what the losses could be. Now, investors like Warren Buffett use asymmetric returns very much in their portfolio, where if you have 10 investments and 5 of them are completely 10xing and then the other 5 are failures, that's a win. So it's very important to know this is for diversification. This is for investors that are very much putting their money in various different assets, and they're trying to gauge and protect against that downside. They're trying to limit the amount of downside and maximize the amount of returns. And that's where the fancy word asymmetric comes in. So that $100 you put into a stock of any kind on the stock market, and you come to terms with the fact, okay, there's an equal chance that I will lose $20 out of that 100 over the next 2-3 years. And there's also an equal chance that I will gain $20 over the next 2 or 3 years. Now, a 50-50 shot is something that nobody would ever recommend to you. That's the flip of a coin. Heads, you gain $20 over the next 2 to 3 years. Tails, you lose $20 over the next 2 to 3 years. That is not a good investment. Or strategy whatsoever. Do not do that. Do not do that. This is not financial advice or investment advice, whatever whatsoever. But very important that is not a good, return potential there. So where does asymmetric return come in here? That is where you do an analysis on that stock. Let's say it's the same one that says, all right, equal chance of $20 losing, equal chance of gaining $20 over the next 2-3 years. Now, what if there is a potential that you will gain $50 in the next 2 to 3 years? Now, that is where the unequal chance comes in. The unequal probability that you will gain either $20 or $50 over the next 2 to 3 years far is going to outweigh losing $20 over the next 2 to 3 years. So once again, to say that simply, 2 out of 3 chance that you are going to make a higher return. You're going to increase your investment. You're going to increase it either $20 or $50 over the next 2 to 3 years, or you're going to lose $20 over the next 2 to 3 years. Now, this is where the fancy term, like I said, asymmetrical comes in, where if you were to look at this with a diagram, that I don't have a whiteboard right now, but if you looked at this with a triangle and you drew a triangle, the upside and the downside, it would look a little wonky. The upside would be much steeper of a triangle, and then the downside would be less steep. because you have 2 up above. You can either gain $20 or $50 over the next 2 to 3 years, or you can lose $20 over the next 2 to 3 years. And that is where you come into focus and realize, okay, asymmetrical is just a fancy word for saying that the upside is far, far greater than the downside, and that is an investment worth adding to the portfolio. Now, that's a hyper boiled down version of what asymmetric returns are. Threw in some intrinsic value concepts there, but it's very important when you're making small investments, big investments. Just make sure that you're always looking at what the losses are and what the probability of gains are. Because yielding asymmetric returns is something that all of the professional traders and investors out there are looking at. They're looking at what their upside is and what their downside is. And just like I mentioned, all of Wall Street and hedge funds everywhere are always looking at their downside first to maintain, all right, that $20 over 2 to 3 years is what we're going to lose, but we can potentially gain $50 or $20 over the next 2 to 3 years. So that investment is worth taking because the upside is far greater of a probability of happening than the downside. So that's my under 10-minute explanation for what asymmetric returns are. I love this concept. I love the idea that a lot of people, when they look at billionaires and millionaires and things like that, they say oh man, they must have taken huge risks. And sure, some have taken massive risks, but the vast majority take very calculated risks. And asymmetric returns is at the beating heart of that calculation, where they are making sure that they're not going to lose more than they're putting in. And they're making sure they're not going to lose any money. They're trying to just completely limit the amount of downside. So that's how it works. That's how the hyper wealthy are investing. They're making sure they're protecting their downside and they're maximizing the potential upside that they're going to be putting their money into. And that's the gist of it. And as a bonus here, guys, I'm going to be leaving the link to my cash flow course in the description below. If you just use invest 20, you're going to get 20% off of that course. If you stuck around through this video, definitely check that out. A lot of you guys have been amazing with feedback and everything. Going to be adding some more content to it, but based on suggestions, investing in buying web properties, doing asymmetric analysis on all of these different web properties, making sure that the downside is covered to a certain degree and your upside is much steeper. That is very much something that I talk about in the course. So that is it for this episode. Slap a like. Definitely check the link in the description to check out that course. And hope you guys like it. And I will see you guys on the next episode here.